All right, all right, all right, all right. My voice is going away already. Boy, allergies. The seasons, they are a changing. How's everybody doing this morning? We have a good little group here already. Nice to see everybody sitting around waiting for us to get started. And try to get started on time. And let's get started right now into our options strategies. Not here to waste your time, just to teach you. So let's come in and take a look at a few things. We're going to go through very quickly. I just want to pull up our previous slide deck that we used in class on Friday. So this is a review. This is the lab for our class on Friday. And my name is Lan Turner. Of course, I'm the instructor down at Utah Tech University for the options class that we had last week. So Monday, Wednesday, Friday last week, we taught an options class. And it's part of our Utah Tech University finance department class. So I'm doing the lab today. So markets are closed when we have our class at night. So it's better to come along and follow up, do a little bit of work in the real markets and take a look at what's going on and show you how some of these options work. All right. So the first thing we're going to do is this is Lan's favorite option strategies. Now there's a whole bunch of options strategies. Now, there's some that are kind of sanctioned, which are kind of the ones that the exchanges recognize, what we call exchange recognized spreads and exchange recognized option strategies. But then there's every other little kind of weird thing that you can do in the world. Just about everything that's ever been thought of has been ever that can be done has been thought of. And so there's been given names to all kinds of different trading strategies. And as you make your rounds out on YouTube and you try to learn a little bit more about options, and you're going to see all kinds of crazy, weird stuff going on. All right. So just be careful. You don't have to do them all. And you don't have to know them all. You just have to find the one or two that really resonate with you and just do those. For me, I've always thought in my lifetime, I don't want to trade my hard I don't want to trade my back for money. I want to trade my mind for money. And so I want to be able to do something with my brain that's going to make me money as opposed to with my back. And so I'm not that smart of a guy though, right? I mean, we all kind of study and we work hard in our individual industries, and we do our best, and there's always somebody out there who seems to always be smarter than me. I always somebody smarter than me, or there's always out somebody smarter than us. You don't have to be the smartest guy in the room to make money at the stock market. All right. You just have to be smart in your one little field of interest. And so my little field of interest is in technical analysis and options. It's really kind of where I've spent most of my time trying to learn how to do something that can make me money with my mind instead of with my back. And so what I'm doing here is I'm just going to show you how I do it. All right. And how I've made money along the way using options. And again, you don't have to learn all of these option strategies. They're fun, and so you're going to probably get immersed in them, and you're going to probably have a lot of fun with them. And I think it's important that once you understand the basic structure of options, you kind of it's easy to suddenly you learn them all because they're really not that hard. I mean, options, people are scared of them, but you don't have to be. There's only two. There's a put and a call. That's all there is to it. There's a put and a call. And then everything else is just a combination of what are you going to do with those puts and calls. So once you break it down into those simplified terms, options are not that hard. And if you think about them, they're just like, it's just like buying a house and putting down your earnest money. So an option is nothing more than earnest money on buying a stock. It's just earnest money. And you're going to either, take delivery of the stock that you buy the option on, or you're not. You're just going to sell the earnest money itself because the earnest money will go up and down in value. You're just going to liquidate the earnest money when it's made money. And that's all you're doing. You just think about it like that. You don't have to take control of the underlying stock. Now, many times we want to own the stock, and make money trading stocks too. But options are just a way of putting earnest money down on a stock. And so we have the right, but not the obligation to buy the underlying stock. And that's really the name of the game when it comes to options. Where buying an option gives you the right, but not the obligation to purchase the underlying asset at a specified price, which is the strike price, before a specific day, which is the expiration day for a specified price cost, which is a premium. That sounds very much like earnest money on a house, right? All you're doing is agreeing to to buy the underlying asset, right? You have the right, but not the obligation. That's what earnest money is. At a specified price. You go to the house and you go, I'm going to buy that house for $250,000. Okay, well, that's the specified price. And then you say, well, it's my earnest money, so how long do I have to come up with that money? Well, you got 3 months. Okay, well, that's your expiration date. That's the expiration date of the option. It's the expiration date of the earnest money. And then at a specified cost, that's the premium. How much do you have to put down for that earnest money? Well, generally we put down 1%. So if it's a $250,000 house, we're going to have to put down about $2,500, right? We put down $2,500. That's the maximum amount of money we could lose if we walk away from the deal. If we walk away from the deal, well, we got to pay our $250,000 or $2,500 if we lose that. But that's the max amount of money you can lose. But in the stock market, in the futures market, when you're trading options, you can walk away from the deal early and get some of that money back, get some of your premium back. And so understanding that is a very important component part of trading, because being able to get some of that money back is how you can really make some good money in this market. You have to be smart about how you do this. Now, one of the biggest problems I would say that beginner traders make, and this is probably one of the keys that I think that if you remember this one thing, if you only learned one thing about this in this class today, is that you can get your money back. You can pay out your money and you can get it back. So you can liquidate your option early, get your premiums back. That's the whole name of the game. Now, I would bet, I would say it's going to be one of these 80-20 things. 80% of professional traders never take their options all the way to fruition, all the way to the expiration. 80% of options probably come off early of professional traders. Now, I would say it's reverse on that for amateurs. Amateurs, it's going to be 80% of them go all the way to expiration. Why? Because they're amateurs, right? That's what makes the difference between an amateur options trader and a pro options trader, is that a pro options trader uses time value, or theta, what we call it, right? We use theta in our favor. So if you're not using theta in your favor, and if you think you have to run those options till expiration every single time, you're an amateur, because amateurs don't understand the concept of getting your money back, the theta decay, when you don't need to go all the way to expiration. In fact, it's proven mathematically that you're better off liquidating at least a good month or more, 42 days, 40 days, 45 days before the option expires. You don't even want to hold the option in that time frame unless you're selling it for premium. Now, on the other side of buying an option, there's the seller. And an option seller or writer has the obligation to sell the underlying asset or contract at a specified price, the strike price before a specified day, the expiration day for a specified cost of premium. So it's a different story on the selling of options. You want those things to be towards the end of the life cycle because they die very fast. And so that's why I'm saying that option sellers have a different story than the option buyer. Option buyers, they generally don't want them to go all the way into expiration. Option sellers generally do, because that's where you make your money the most theta decay, the quickest. And so people get confused about the option seller and option buyer side. There's only two sides. There's a buy, and you can buy a call or you can sell a call. You can buy a put or you can sell a put. And so the name of the game is to understand both sides of the same coin. And so this is what confuses people about options. But options, you just have to remember, hey, if I'm buying it, then somebody has to sell it to me. And when I buy an option, I have unlimited profit potential, right? When you buy an option, you have unlimited profit potential, but the amount of money you can lose is restricted to the premium that you paid, the specified cost. That's the maximum amount of money you can lose, but you have unlimited profit potential. That's the buyer. Well, if you come over to the seller, well, he's going to have just the opposite of that. The maximum amount of money he can make is the premium that he received from the buyer, and he has to give unlimited profit potential to the buyer, so therefore he has unlimited loss potential. Well, if a seller has unlimited loss potential, why would he ever sell an option to an option buyer if he has limited profit potential and unlimited loss potential? Well, for the premium, of course. So It's a strategy. So it all comes down to strategy. And a lot of people are like, well, options, if I'm learning options, I don't have to learn technical analysis. I don't have to come over to these charts and sit here and worry about whether the markets are going up or down. That's the other biggest fallacy in option trading, is that you're disconnected from the underlying stock. That's not true at all. It's the movement of the underlying stock that changes the value of your option up and down. That's the whole name of the game. I call it a carnival game all the time, and in options, it's even more of a carnival game than it is even in stocks. I mean, we talk about, in stocks, you buy your stock, and if the market goes above your purchase price, you make money. If it goes below, you lose. It's a simple carnival game. But the carnival game comes down to the point of being able to decide where that little snaky thing on the screen's going. Is that little green and red snake going to go up, or is that little green and red snake going to go down? And so you make your decisions based on that. Or is the little green and red snake going to go sideways? Oh, well, I don't have to worry about that because I'm just going to trade options. BS. That's exactly what you're doing with options too. You have to understand how to read a chart and know what the probabilities are of a market going up or down. And is the market in a high probability state of rising, or is it in a low probability state of rising? We have to know what the options are. We have to know what the odds of the underlying market are. We have to know whether they're in a third standard deviation. We've talked about the delta cone of probability ad nauseum. So that's all comes from options. Where do you think delta comes from? That's why I call it the delta cone of probabilities. It comes from options. It comes from the options chain, right? So we come down here and we have the delta, and the delta is the options chain. So it's part of the options chain, it's part of the delta of the option. That's where we get the delta cone of probability. And that's how we know whether markets are in an extremely overbought or oversold region based on those mathematical models. And you can see them built right into the options tables. There it is right there. Probability of being in the money, probability of being out of the money. And those numbers are all calculated. You can see that an at the money option right here, this is an at the money call option, has a probability of being in the money 52% and has a probability of being out of the money 49%. So it's roughly at the delta center, it's almost 50-50. You have basically a 50-50 chance the market's going to go up or down. But then when you come over here and look at delta, you notice that delta's sitting at 48. So 48 and probability of being in the money are almost exactly the same number. So that's how those numbers are actually derived. I mean, they're tables where they show you where the probabilities go in and out of the market, but it's just delta. It's all calculated on delta, and that's why we call it the delta cone of probability. And so then you look at a stock and you add that, or you apply that to the market, and you can tell where a market's in the 1 standard deviation, 2 standard deviations, or 3 standard deviations away from the center of the current stock rally. What you're doing is you want to look back about 1 year, just as a rule of thumb, and you want to find where the low and the high are of the last rally. So we're going to come way down here to the very bottom of this last run, and we're going to run this all the way up to the top. And so if you run that up through the top, that ends up, this is what we call a Fibonacci ruler. It's just a delta cone of probability. It's a probability calculator. That's all it is. Don't think because it's got a big fancy name. It's just the guy's name that came up with it. So Fibonacci is just a man's name. So it's just a calculator. It's just a ruler. A lot of people get scared of rulers because they have numbers on them. It's not a big deal. It's just a ruler. All right. Don't be scared of it. All it's doing is it's telling you that this is this 1 standard deviation of that move. From the low to the high, the 1 standard deviation is right here. Dead center is 50%. You have 61.8 on the bottom, 38.2 on the top. What? That's crazy. Why don't they just say 40% and 60%? Well, because it's not a Fibonacci number. It's calculated based on a mathematical number called Fibonacci. You can do a little bit of research into Fibonacci and find out why we use those numbers, but it's because they're common numbers. And so this is where we look. And in the financial markets, hold on a second, I'm losing my voice. In the financial markets, we're always using mathematical models to help us design our trading decisions. And so this is your 1 standard deviation. And so when a market comes out and market starts out, let's think about it from when the market starts. Well, if it starts way down here in, you go back into the past. All right, let's just drag it over here. you have another Fibonacci ruler back over here, right? So you have to go off the previous Fibonacci rulers. So we go back and we'll say, well, here's another Fibonacci ruler back in here. And so it went up like that. And then it came all the way up and it came all the way back down into the Fibonacci sweet spot. And then it broke out to the bottom because it was a bearish market and went all the way down here. So this ends up resetting, and we generally go off the low down here. So if we say, well, that's the previous standard deviation, we can delete all these and put this in here like this. And we go from this low to this high. That's where we end up with our delta cone of probability for the rising market. So then we get the market going up into the higher highs, and we get Fibonacci projections. And you can right click on here and you go Fibonacci lines or Fibonacci projections. We're going to display the projections. Actually, we're going to do I've got it changed. Let's see, how have I got it drawn here? Let's turn on the Fibonacci projections retracements. So display those, and you can see that they go up above the market. So this is how you get up into these other ranges up in here, just like that. And you can see that the market went from the previous high here to the low here. That's your one standard deviation that we're looking at. And then the Fibonacci projections give you the projection of where they think that market's going. I didn't mean to move the ruler. Let's put the ruler back where it belongs. And now we're going to move that market. Why is it going like that? It must be going off the screen. Let me grab down here. All right, so see, that's where those Fibonacci projections went to off that last. And you think I make this stuff up. Look at that. It's like a train on rails. I mean, those Fibonacci numbers matched up with the previous trend. See, we started here, A to B, from the top to the previous one. We went off the last one. It went down to the bottom, and then we draw our Fibonacci rulers in there. It ends up being your one standard deviation. And then we see the projections project up higher. How high did it went? It went right up to 161.8. See that? 161.8. And that all came off of that A point here and that B point here. And people think, oh, Fibonacci doesn't work. Fibonacci works because it is what it is. I mean, Fibonacci, it's not like it works or not. It's just a ruler. Oh, Fibonacci ruler. Oh, it's just a ruler? Yeah. You can't say it works or not. Of course it works. How big's your foot? It's 1 foot. Is it your foot 1 foot? Well, no, not exactly. But why do we call it a foot? Because it's a foot long. No, I don't know why you call them feet. Where a foot came from, right? This is the same thing. It's just a ruler. And so it's not like it works or it doesn't work. You just measure things with a ruler. And then the markets have a tendency to move through those things. And sometimes, because the big banks and hedge funds use Fibonacci numbers all the time, they do. You're like, oh, maybe they don't. They do. How do you know, Lan? Because I worked at the Chicago Board of Trade for 10 years, and I know what they taught them. Then I went to the Temple of Finance, and I worked there for 10 years, and I studied there myself for 10 years. That's how I know what they teach them, and they teach them Fibonacci. And I will tell you that 90%, well, not 90%, about half, 50% of the kids that are out here on YouTube doing their Fibonacci numbers are doing them wrong. They'll stumble across it right once in a while, and that's okay. You just got to realize what it is and what it's used for. So there's your Fibonacci extensions. The market came to it, and oftentimes, the reason that the point I'm making here is that this market has a tendency to come to these numbers just because everybody uses Fibonacci. And so because everybody uses it, it becomes self-fulfilling prophecy oftentimes. And so this is why I had confidence that I knew that I was in the third standard deviation away from the center of the cone. I was up here at 161.8. That's why I had confidence to put $250,000 on a short position up in here. And I put it up in there, and that market started to make a nice little wedge pattern. And I put $250,000 in the market right there. Now, was it a big risk? Everybody's like, oh, you're so brave to put $250,000 on a short position and the market's going up. No, I wasn't brave at all. It was just smart. It wasn't brave at all. I had such a high probability of the market dropping. I'm at 161.8 against an entire retracement trend. Yeah, but the war. Yeah, but Elon Musk. Yeah, but Apple. Yeah, but AI. It's not how the market works. If you think it's all based on fundamentals, you're drunk. It's not. Now, is a lot of it based on fundamentals? Yeah, of course. It's what drives the long-term trends is fundamentals. But the big hedge funds and the big traders, the big market makers, they trade the market. They don't invest in it. They don't buy and hold it. They don't put their money in there and just leave it. Now, some do. BlackRock has some money for, firemen and policemen and long-term investors, and they manage it in that way. But they're still trading. They're still moving money around. They're still manipulating the markets in ways. These great, big, huge hedge funds are still manipulating markets. So when you're trading, you're always picking direction. I don't care what anybody tells you. Oh, when you trade options, you don't have to pick direction. Bull. BS. Of course you have to pick direction. You have to know whether the market's going to rise, fall, or go sideways. And that's how you determine your strategy. You got a lot of strategies that we're going to go, and we're going to go put some of these on. But I want to give you the foundational structure of why you need to put on different strategies for different purposes, and what the probabilities are that markets are going to rise or fall through. And I pulled this window up before, but this is our accumulation distribution model, the Richard Wyckoff accumulation distribution model. And this is how we determine where we're going to put our money. All right. So see this market, this model right here. Look how it's almost, it's, come on, little Apple or little Microsoft. Let me shrink that. This model right here is what we go off of. So market goes through its accumulation stage. It goes up through a big rally. It goes through a distribution stage, and then it falls back down. It goes through the markdown stage. And we're coming through the markdown stage on the market right now. Why does it do that? Lane, you can't say it does that every time. Well, you go back and look in history. Don't expect, just because I've done it doesn't mean you got the confidence. I've done it a million times. I've looked at a million charts. If you don't have a software program that lets you go back and look in historical charts, get a different software program, because that's how you learn. You got to be able to go back and look in history and say, well, Land said that markets have a tendency to do this. I'm just going to have to believe him because I have a crappy software program that doesn't let me go back and look myself. Well, you got to get a software program that lets you go back and look at historical charts, or else you can't trade. How are you going to learn if you don't know what markets have done in the past? Past performance is not necessarily indicative of future results, but it's the best we got. And why would you avoid the best we got? The best we got is looking at past performance. So that's how we do it. You got to have a software program that lets you scoop back in time and go look at those old charts and see what markets did, so you can practice and learn, so you can have confidence in what the markets are going to do going forward. And so that's what these markets are. This is kind of the pattern that I look for. Now, do all markets do this pattern? No, of course not. But most of the big ones do, the big ones that the big banks and hedge funds love. And so that's why we look at them. And definitely the indexes do them. So here you go. So how did I have confidence that I thought the market would going to fall, put $250,000 on the short position right here? Well, because it was part of the model. So it's what I was saying before. You don't have to be good at everything. Just be good at one or two things. And if you have a little model that you can go off of, and you start seeing a market going through the model, and you can look at the delta cone of probability, and the probability say, well, market's going to go up or the market's going to go down. That's how you determine which strategy you're going to put on your position. Okay, so you got to understand that just putting on options is not just a simple, oh, I think I'm going to go buy a call, or I think I'm going to go buy a put. You got to have a strategy behind it. So let's go look at some strategies, and that's the whole name of this this class. Going to go put some strategies on. So that's what that is. Okay, so that's how you figure out your strategies. That's how you know where you're going to go, and you anticipate market's going to come back into those Fibonacci sweet spots. All right, so right now you can see it's bouncing off of 127 projection up there. So this is based on the entire trend from high back here to low. The Fibonacci extensions were right now at 127. I think we're going to see it come back down if we take this ruler, redraw it. I think we're going to see it back down in this region here. Let's come in with the Fibonacci ruler. Now this is the Qs. So this is Apple, Amazon, Netflix, Google. They're all the tech companies. There's 100 big tech companies in here. Okay, so I think we're going to see it down here at least 38.2. I think we're going to see this market come down to here. Will it? I don't know. There's another number in there that I got turned off because I don't like to only say 23.6, but that's where it's at right now. So it's sitting right back at a 23.6% retracement of that last move. So from here up to here, back to here, well, back to here, it's only at 23.6. That would be 38.2, roughly 40% return. This would be a 50% return. This would be a 60% return. Now, markets like to come back, and we know around 60% of the time they like to come back into this region here. Doesn't mean they have to, but 60% of the time, that's kind of what they do. They come back down into here. So is it going to come back that far? I don't know. but I'll just watch and see. And I got recurring price patterns that I'll watch, and indicators and MACD, and I got little lines in here I'll draw, and I'll just keep an eye on it. And if it starts to come back down here, I'll start taking my profits off, and just slowly, take profits off, take them off, take them off, take them off. So when it gets down here and starts turning around and go back up, I don't have my full $250,000 sitting on here on a short position. I'm taking profits off. Now I should take some profits off, technically speaking, right here at 23.6. That's one of our target zones where I should take some money off. I'll take some more money off at 38.2, some more off at 50, some more off at 60. If it keeps coming down, that's how you do it. You dollar cost average in, you also dollar cost average out. So when you got your big position, you dollar cost average out, and then you dollar cost average back in, right? That's how it works. So you take your profits along the way as it comes down, and then as it turns around, we put a bunch of money back into the accumulation stage, and then we start to take our money back off. We dollar cost average back out again on the way back up. So we just reverse it. I'm short now. We'll be long by the time we get down to 61.8, and then we'll start taking it back off as it starts to go back up. That's just how you do it. Now we're going to come in here and let's go over and look at some individual. Let's go look at the Dow. This is the Dow, and let's see where it's come already. Let's make sure we're at the bottom here. Let's shrink this back. Okay, so the Dow is already, if we go off this low to the high, we're already back at 38.2. So the Dow only has 30 stocks in it. The NASDAQ has 100 stocks in it. And the S&P 500 has 500 stocks in it. And it's already back at 38.2. Is it going to break down and come down into this region down here? I don't know, but I think it will. The odds say it will. But, sometimes it's only like 68%, 65, roughly 65% of the time that the market does come down into here. So a little bit better than half. So it could bounce around at 38.2. And of course, then the fundamentals will kick in, and what's going on in the war and how people feel and confident in the future, all that kind of stuff, right? And of course, if they keep printing money, the government keeps printing money so they can pay their bills, that'll force the market up too. Did you know that? Of course it does. These are assets. And anytime your dollars become diluted by quantitative easing, which is what it is when they print money, that's just a fancy term for printing more money. It devaluates your money, so your assets go up in value. So that's why the stock market always goes up. You think it's because of fundamentals, like, people are buying more toys at Toys R Us. Stock market's going to go up. No, actually, you know what makes the market go up all the time? It's quantitative easing. What makes it go down? When they slow down quantitative easing. So these are assets. Therefore, when you print money, it causes them to go up in value. That's how it works. So SPY. This is the S&P 500. Let's come back here and see where the bottom of that thing is. Look at that. Wow, what a run. That thing is amazing. All right, so we came up here. Let's go all the way to the top with this thing. And we're just going to see how far back it's coming back against its trend. That's all we're looking at. And it's come back. If we come in here, Fibonacci lines, we got to put on the 23. So it's right, there's 23%. So it came right back down, touched 23%. All right. Now, the Dow only has 30 stocks in it. So it goes a little bit crazier, faster, right? It's kind of leading the pack. And it's already back down to 38.2. So that means that, 38.2 on the Dow is basically equal to 23.6 on the Qs and 23.6 on the S&P. Does that mean it's going to come down? Well, we're going to watch the Dow, because the Dow is a little bit more sensitive. So if it turns right here at 38.2 and starts giving us indications that it's going to start making patterns to go back up, we probably want to start looking at liquidating our short positions on the Qs. But if it comes down and breaks this and comes down into here, well, it's likely the Qs are going to follow. So we're still short. We're not ready to take them all off yet. Might take some profits, but that's it. Okay, so how are we going to do these option strategies? So let's come in, and the very first thing we do, let's come over to our research page, and let's just go look at an individual stock. We know we can trade options on the indexes, but we're going to come in and look at some individual stocks. Let's look at Apple. Everybody loves Apple, so we're going to come in. We're going to do the same thing with Apple. Apple's kind of in that same thing. We're going to look at where we think the market's gone. It's come back down to 38.2. It rallied back up, made it another nice little double topping formation in here. So anytime you're going to use your options, you got to think about what it's doing, what the market's doing. And then we're going to come down here, and it looks like it's trying to bounce off that 50%. So it came back to 50% right here. See, you can see this delta point of return right there. 68% of the time it comes back into there, right? So now it looks like it wants to rally and go back up, doesn't it? This is a higher low. This is a low, and now it's making a higher low. Now it doesn't mean it can't make a little bit of a run and then flush down one more time. That would be 3 drives down. Drive 1, counter trend, drive 2, counter trend, drive 3. We might get that. So, well, we don't want to just jump in with a whole bunch of shares. Let's come in here and buy an option. So we're going to come in, and the very first option we're going to do is we're going to come over here. And remember, we just look at our little table, and it says if we think the market's going to go up, we buy a call option. If we think the market's going to go down, we buy a put option. So we're going to keep it simple. We're just going to go right off that. Now, of course, this is the selling side of this, but we're not talking about that right now. Right now, we're just going to do the buying side. So what we do is we're going to just come in and we're going to buy a call. It's called a bullish call option. So we're going to come in and we think the market's going to go up. We're going to buy a call. Now, why are we going to buy a call? Well, and how long should we go out? Well, how long do you think you're going to need the call? And remember, it comes back to the delta cone of probability, and it comes back to all those things that we talked about in class, where how long do you think you need the option? For me, I like to come down. I thought I had the delta cone of probability in this slide. Oh, there it is right there. So this is your delta cone of probability. All right. So what we're doing is we're going to come in and we want to buy the long call. And we're just, the way you do it is real simple. You want to determine using your Fibonacci projection rule. Now, this is another Fibonacci tool. ABC. Remember, we have ABC off the Fibonacci ruler too, just like that. ABC. All right. So he tells you where your Fibonacci sweet spot is, but then this little overlay does the Fibonacci projections. Remember, we use the Fibonacci projections on here. You can do them in both ways. This tool is a little bit easier. I like to do it this way. So this tells us in price and time. Price and time. So I like this tool because it goes from the A point to the B point, back up to the C point. So it went back, you can see it went back 83% against the previous high. And then it's flushing back down again, just going down through the Fibonacci scales. There's 23.6, 50, 61.8. So it got down here to not quite 90. It's right up there around 61.8%. So that's right there where we'd expect it to be if you were to draw your Fibonacci ruler from B to C. It's going to give you that same thing, right? There, right back into this pullback. And this is the Fibonacci sweet spot. So now we're anticipating the market's going to rise in price. So we're going to come in with this tool and we're going to do it again. We're going to come in and we're going to say, oh, well, if it goes like this up here, and just make a little projection just like that. Oh, well, if it goes up, basically that same rally from here to here, well, we'd expect it up in here somewhere around April 9th. So that would be going if it went that same volatility scale. But I like to give ourselves a little bit of time. So this might not be quite that fast. So we could come out here and say, well, where's that volatility? How volatile is this market going to be on the way back up? Do you think it's going to take off like a rocket ship? It might. Of course, it might depend on some of the fundamentals, right? It might depend on whether Donald Trump sends out a tweet or not, and whether it's positive or negative, how fast that market might rise. But if it rises the same speed as it did last time, which is right here, then this is where it would end up here, just like that. Very simple, very easy. Very calculation. So you want to do your math like this. This is the most important part of trading options, is figuring out where you think that snaky thing is going to go. So now we're going to come in here and we need some time. Now this one says we don't need a lot of time, because if it follows through with that same pattern, now this is still could be in a down pattern, but it looks like this is a higher low than this high and it's trying to go back up. So we're not sure. So that's why we buy an option, right? Oftentimes the reason you do options is because you're not sure about which direction the market's going to go. But you can say that, well, I probably need a little bit of time. I probably need out here April 7th. But I like to have at least 30 days or 45 days more time than I need. And then I like to have a little buffer beyond that. So I'll take another 30 days. And then the amount of time that we have. So we're going to go like this. We're throwing a little time calculator. We're going to come in here and say, well, we're going to need from here, let's say back just to the previous high, we're going to need 26 days for that. Land likes to have another 30 days. So we're going to go another 30 days, and then we're going to go, well, now I like to have another 42 days after that. So I need about 100 days on my option to determine for this trade. Why? Well, because I think I'm going to take my profits within the first 30 days. I want to have a 30 days buffer in case the market's not exactly, going to take off like the rocket ship is predicting. Maybe it's out here, it goes a little slower. So I need that extra 30 days for that. And then I need about 45 days because I don't want to get caught in the drop off of the theta decay, of extrinsic value decaying away. So that's how I determine how much time I need on my option. So now I'm going to come in here and say, okay, that means you need around 100 days. So you come down here on the table and you say, I need about 100 days. There's one right there that's dark. And remember, I always like to do the dark ones in track and trade because they're the ones that are going to have the most volume and open interest. And we need to have those guys because those are our friends, right? So we want to go trade where all of our friends are. So we click that one there. And now all we have to do is just say, well, where do you want it? Well, we probably want it right at the money. We just want to buy it right here, just like we would if we were going to buy shares. Well, why don't you buy shares then, Lan, instead of an option? Well, if we come over and look at the shares and I want to buy 100 shares, remember, each option represents 100 shares. That would cost me $25,000. So I'd have to have $25,000 to put 100 shares into that market. Well, you don't have to buy 100 shares. You can buy 50 shares. Well, that's true. You can. Oh, you buy 20 shares. You can buy one share if you want. You do whatever you want. But options represent this minimum amount. The smallest amount options trade is 100 shares. But that's at expiration. Remember, at expiration, because delta tells you about how much money the market's going to make. This option is going to make based on the delta of the market option. So it's going to say right here, it says a delta of 0.55. So that says when you put this option on, and we're just going to buy a call, just right here, just push the button, come over here, drag it on the screen, and put it right on the screen. And it's going to tell you, highlights it down here in the window, and put your little marker right up here so you can see where you're going to buy it on the screen on the chart. And then you come in here and you say, well, it's $1,677. And the volume's 42. That's low, but open interest is high. The spread is $20. It's not the greatest, but it's not bad. We could probably get $10. We'll do halfway between. And then the probability of being in the money is 55. The probability of being out of the money is 44, which because it's right dead center of the delta cone of probability, right? At the money is always dead center of the cone of probability. So your delta is going to be 55, which means it's going to make or lose the same amount of money as if you had 55 shares. Oh, well, that's pretty cool. Yes, and if you would have put in 100 shares, but of course, by the time the market gets to the purple line, which we'll probably never get there. We probably won't hold it that long, but we could, there's reasons why you would or why you wouldn't. And then if it gets to that point, then delta will be 100. So it'll have convexity and delta will keep going up. You'll keep making more money faster. Or if it starts going down, you'll start losing more money more slowly. See, because delta goes down. Let's go both directions. Let's come in here. Calls, we'll go both directions. And we'll just do out of the monies. So you see delta, this is the delta cone of probability, and this is what we call the convexity. So delta starts at 55. If the market starts to fall, delta goes down. See, it goes 40, 35, 30, 27, 23, 20, 15. So delta goes down. You start losing money more slowly because it starts trading less and less delta. And if the market goes up, the delta gets bigger. So it goes 55, 40, 40. Well, this one's going the wrong way. So we go this way. So now it starts to go up. So you see it's going, well, let's got to get the right one in here. We got to get in the monies. So there we go. Okay, so now it starts to go up. See, 45, 50, 56, 62, 68, 73, 79. So the more money you make, the higher the delta goes. That's good too. And the closer you get, so delta keeps going up, 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 up as the market goes in your favor and you start making more money more quickly until it gets to 1.0, which is the same as the underlying stock. So really what you're saying is, Lan, is that you're putting this options on at the money and it's costing me $1,685. But if I was to put the equal delta on, which would be roughly 45, right? Let's just say 50 right in the center. Well, it wouldn't be 25. It would be 50. So instead, that would be roughly $12,000, right? So roughly $12,000 instead of $1,600. We're going to make the same amount of money. So that's why you do it. And the max amount of money you can lose is the premium you paid for it, $1,685. That's the advantage of an option. Now, the problem with an option is that the market has to go up, and it has to go up faster than the option decay. Now, remember, the options decay. The options decay, they start to lose value the minute you buy them. So they're a decaying asset. The minute you buy them, they start to lose money. And they're going to lose money on this scale right here, roughly $13 a day on average. That's what that is. Premium per day that you're going to lose is $13 per day. So the market has to make $13 a day just to break even. So what we're going to do to find out what our break even is, we're going to take that number, 1,685. We're going to take our little dollar calculator. And remember last Thursday, we did this. And we went and looked at the little scale. And you just put that on there. You say 1,687. Just put that at 1,687. It's right there, 1,687. That's close I need to get. And then anything above that is going to be profit. Anything below that, you're going to lose money. Okay, so as long as it's up in here, as long as it trades up in here, you'll make money. If it trades in here, you'll make a little money, but it won't make all your money. You will have paid more than you made, so you lose a little bit of money. And then down here, anything below the line that you got into, everything down here, you lost everything, all your money. So you lose all your money, you lose some of your money, you lose none of your money, you make money. So that's how a long call works. And you can just see it right on the screen. And it's really important to have that on the screen. It's really done. You need to understand what each option does when you buy them and sell them. That's why you have a call here. You're going to make money on that. And as long as the market stays up there, you make money. Again, it's a carnival game. So that's how it works. Where's that little green and red snaky thing going to go? That's why it's important when you trade options that you understand probabilities of markets and how to read charts and whether they're going to rise or fall, because you're going to put that order on there and the market has to stay above that little trend line that we put in there, or else you're going to lose money. So you need to know that. That's why it's important to know how to read charts. That's why I teach a technical analysis class, to show you guys how to read charts so that you can put options on them or buy them. All right, so now what if the market falls? Let's go put this on. Let's come in here. I'm going to delete all the tools. So let's put that on. Let's come in here and I'm just going to mark it into it. I'm not, because see if it'll let us have it. Okay, so now we have a long call. But what if we think the market's going to fall instead of go up? Well, we could do the exact same thing. We're going to put on a put, buy a put. So you come in here and you put a put option on there. Are you going to do them at the same time, Land? Well, you can. You can put them at the same time if you want. This is called a straddle or a strangle, right? So we come in here and we're going to go to the next level. Now the put side is just you buy a put if you think the market's going to fall. So there's the put. And we're going to come down here. And we're going to go to the next straddle. Going to be where all your friends are. Okay, we're going to put on what we call a straddle. Now a straddle is the same thing as a strangle. We're going to come down here a little bit. There's a strangle. Straddles and strangles are the same thing. All it means is that there's a gap between them. So let's go look at how that looks on your chart. So right here, this is going to be a long call. And if we just put this one on, it's a long put, right? Meaning long means you're going to make money if the market goes down. If you had a short put, then that means you would sell the put. But we're going to be long the put because we bought it. So we're long the put and we're long the call. It means we bought the call and we bought the put. So now we're going to come in here and you can put this put wherever you want it. You can put it right on top of it if you want to. Now, if you didn't have the call, let's say we didn't have the call. Let's just exit the chart. So let's say we didn't have the put, the call, and we just thought the market was going to go down. Well, very simply, you just come in here and buy a put. And again, the timing, I told you how to decide how much time you need. You're just going to do your Fibonacci projections and then add some buffers in there. So that's how then you come in here and we're just going to mark it into it, mark it in. You're going to buy the put. Now you're going to make money if the market goes down. There you go. That's a very simple process of buying a put and buying a call based on your theories. Okay, so let's exit out of that one. And it's really just that easy. So now we don't know which direction the market's going to go. Maybe it'll go up, maybe it'll go down. So we're going to use a straddle and a strangle. And now all a straddle is we're going to come in here. It's easier to think about it as a strangle first. Let's come in here and do a strangle first. We're going to buy a put, or buy a call. We're going to put the call up here, and we're going to buy a put, and we're going to put the put down here. All right, so now we got a call and a put. We go ahead and we'll mark it into those. Now what that does is that if the market goes down, well, you'll make money on the way down. If the market goes up, you'll make money on the way up. But now you're going like, wait a second, Land. You've got 2 premiums on here. That's exactly right. So if we're going to come in here and look at it that way, now we have to take these 2 numbers over here, 1,400 and 15 and 11, 1,400 and 1,100, and we have to add those 2 together. So the first thing we're going to do is we're going to have this one here, 1,400 has to go up, right? We take our dollar calculator. If we're just going to do a long call, we'd have the expiration out here at 100 days. We're going to take our little calculator and we're going to go up, right? We're going to go up and we're going to say 1,415. 1,415. So that means it would have to go up to here to break even on the call, right? Well, if we do the put, 1,115 would come down here to break even on the put. 1,115. 1,115. That's about as close as I can get it. So you'd say that if you had just a call, that would be your break even. And if you had just a put, that would be your break even. But we don't have just a call and just a put. We have a call and a put. And because if the put goes down, this is the max it can lose is 1,415. Well, that means that this call has to not only make its own premium back, it also has to make back the premium of the call on the other side. Ooh. Okay, so we got to put that in here. $1,415 plus 1,115. How much is that? So it's 1,415, about $1,560. So we got to come down here, $1,560, not 1,500, 2,600. Oh, 2,600. Yeah, it's got to come all the way down here. 2,600. It's got to come down to about right there to break even by that expiration. Whoo, okay. And that means it's got to go 2,600 up here too. 25, 26. So that's your break even. That's your little triangle wedge formation in there. All right. So if you want to look at it like that, that's your little, and that we should make that red, right? Because that is your lose zone. So that's your loser zone. Let's make that red. Preferences. There you go. If you buy a call and you buy a put, well, it's got to be outside of that zone, or otherwise you're going to lose money. Now your max loss is going to be right dead center. So if you go this way, you're not going to lose the whole amount, and if you go this way, you're not going to lose the whole amount. So the further out you get away from that dead center is going to be more money. And then of course out in here, anything out in there, you're going to make money. So a lot of people, remember we talked about this in class. I said, well, what is easier? Is it easier to determine where the market's going to go or where it's not going to go? Where is that little snaky thing going to go? Is it easier for you to know where it's going to go or where it's not going to go? Because you just set up your strategy one way or the other. So in this one here, we have to know that the market's going to, we got to believe that the market's going to go outside of this. Now it can go outside of it like this and make a whole bunch of money, and then it can come back in and you can lose your money. And then go back out, you make some money, go back in, you lose some money. Back up here, back up here. It can do all kinds of stuff, right? It could come up here and make a whole bunch of money and go all the way down here and make a whole bunch of money. Come back up in here, lose all your money. There's all kinds of things the market can do. Market's a nasty little bugger. It can do all kinds of things. But all you have to do is just decide, well, I'm going to buy that option. So as long as it's outside that triangle, I'll make money. But Lan, I think it's going to stay inside that triangle. I think the market's just going to go sideways and stay inside that triangle. Well, all you have to do is reverse it then. Then all we would do is come in here, and instead of buy this, we'd sell it. If we sold it, then this would be green. And then all you'd have to do is just say all the market has to do is just stay inside of that, green zone. If it's anything inside that green zone is going to be profit. What do you think of that idea? Instead of buying them, now you sell them. So you can decide whether you think the market's going to stay inside the zone or not. So you get to decide. Do I think the market's going to go outside the zone? Or do I think the market's going to stay inside the zone? Before you were like, oh, I think the market's going to go outside the zone. And then you looked at it and then you go, oh, I think the market's going to stay inside the zone. So I said, okay, well, if you think it's going to stay inside the zone, make money when it stays inside the zone. Now you're looking at it, you're going, oh, but what if it goes outside the zone? Because if you sell these instead of buy them, you have unlimited loss potential, right? So this is called this one here. This is called our strangle. So in our book, this is called the strangle. So let's go back up to the straddle, and we'll do a straddle. So now we're going to come in here and we're going to clear all this out. Go to our options. We're going to exit all, and we'll say okay, exit all, and let's get rid of all of our drawings. Get rid of all of our calculators. So now we're going to come in and we're going to put them right on top of each other. So we're going to buy a call. We can put it right on top, right at the money. Buy a call. And we're going to buy a put. Now this is called a straddle. Okay, when you put them right on top of each other. Well, we got two of them in there. You can see them. The one's a call and one's a put. We're buying both of them. Buying a call and a put. You're like, doesn't that cancel them out? No, it doesn't cancel them out because you're buying a call and you're buying a put. You're putting them right on the same price. That means same thing. You're going to make money on the way down. You're going to make money on the way up. The difference is that you got more premium, but the market's also got a higher delta. Remember when we did them out there, the deltas were, let's do the out of the monies. So the delta to the call was like 40, and the delta to the put was like roughly 40, 35, 35, 40. So they were only making them about as much money, 30 cents instead of 50 cents, because the delta was lower. When you push them out, see, the delta goes, you get smaller deltas. Put would be on the bottom side. Call would be on the upper side. So we're going to have smaller deltas. All right. So the delta on here is 41 or 31 down here. Let's pushing that, we'll go up there. So now it's 31 and 41. They're the same distance away from the at the money strike. So the delta's smaller, so it's making less money. But you also had to pay less for them. Premiums were less. So if we put them right on top of each other, well, what does that look like? Well, if we put them right on top of each other, now you're going to see that you're paying $3,208. Over here's your little calculator, tells you $3,208. So now what we have to do is we have to take our little dollar calculator and we have to go out $3,208. $3,208. $3,208. That's about as close we get on that side. $3,208 on this side. $3,208. That's about as close we're going to get there too. So there's your new delta. There's your new delta cone of probability, right? Your new delta cone. So now, because we're buying them at the money, you say, well, it's the same, Lan. Yeah, it ends up being just about the same. So that's how it works. So there is your cone once again. And so if it stays, because we're buying them, if it stays inside of there, oh, we got it backwards because we're buying them. So if we come into our preferences, we got to make that red. So there's you're buying them. So there's your red zone. It's almost the same, wasn't it? Because you're like, well, the amount of money you're paying for it is more money. The break-even zones end up being about the same, but the fact is, it's actually the front of the cone is smaller. If you notice, the last cone went out to about here, and now this cone is a little bit smaller. So the cone is smaller in the beginning, but at the end, it's a little bit bigger because it's bigger numbers. So right in here, it's easier to make money at the front end. So oftentimes what we'll do is we'll put these on and we'll say, well, if the market pops out of here and goes up here, we'll just take our profits off right there. And you're like, well, if you're going to do that, why'd you make it so long? Well, so the decay is smaller, slower. So we're not losing as much money. So we can keep some of that time decay, right? So if it just shoots up here and makes us 20, 25% return on our money in the first like 2 or 3 weeks, we just get out, we take it off. That's what I was telling you earlier. Most professional traders don't ever let it go out into expiration. Why? Because the odds end up being worse and worse in their favor that the market's going to be outside the cone. But if you do it like this, the odds of the market being outside the cone at the first 30 days is really high. You got a real high probability the market's going to be outside that cone. So you can take your profits off. Because if the market goes up here and you're making lots of money, everybody always wants to hang on to it so they can make more money. But as you hang on to it longer and longer and longer and longer and longer and longer and longer, you end up going into a zone where the odds start going against you. So by having a little tiny short cones, if you went out and only did 30 days, well, your little cone would look, it'd be, this little cone would go something like this. If you only did 30 days, your cone would look like this. And then the market would be really good for the first day or two, but then the first, the first few days would be really good, but then the odds start going against you really fast. So you want to extend that cone out so that you get a short cone at the front. See, that's how it works. Kind of fun, huh? So it's like I keep telling you, it's a carnival game. You just have to decide how you want to play the carnival game. What do you want to do? And again, it goes to what I was saying earlier. The reason you do this, you don't have to be good at everything. You just pick the one that kind of resonates with you. And you're like, oh, I like this. This is really cool, man. You mean I have a really tiny little cone here at the first for like the first 30 days. I could just like All I have to do is just be outside that cone of the first 30 days and I can make money. Yeah. Cone's small at the first. So if you think it's going to explode out of there, it would be a good strategy. But just don't, wait for it to come back in. Get out of it before the odds go far against you. All right, that's a strategy. That's called those are straddles and strangles. Now, that's for buying. Now, if we're going to sell, it's going to go the other way around. Remember, if we sell it, we're going to come and go the other way around. So let's come in here and pretend like we're not going to buy these. Let's come over to our option strategy. We're going to exit out of all these. And, oh, no, cancel. I don't want to do that. We're going to go exit chart only. Yes. Okay, so we're going to get out of those. Now we're going to come over here and we're going to sell a call, not buy it. We're going to sell it. And then we're going to sell a put. We're going to come in here. We're going to sell it. Oh my goodness sakes. This is so much fun. Okay, so now what do? Well, we make our little triangle again. We just come in here and we say, well, what's the odds? Okay, we're going to draw our odds in here. So it's $3,200. Same thing as last time. We're just going the opposite direction. We're just going to have a different color, right? So now the market just has to stay inside the market. 3,200, 3,200, 3,200 right there. And so now you got a little triangle that's going to be green this way. Instead of red, it's going to be green. So we're going to draw it in here just like that. And we got to change the color. So it's going to be green. Okay, so now we got a green zone. So now the market has to stay in here. So now the longer you hold it, the more you're going to make, right? The longer you hold it, the more you're going to make. Because at the first, your chances of making money are really low. But the longer you hold it, the more chances the odds go in your favor that it broadens out. Okay. So, but Lan, you just said a minute ago, if I do a little short one, it's going to go like this. That's right. If you had a little short 30-day option, that's going to be your odds. So the market would have to stay inside of that little triangle if you only did 30 days, right? Think about it. Think about it. Draw it on the screen. That's how you learn. You don't just do those little stupid little math calculator. Oh, I got a little math calculator that shows me the arrows. Oh, great. Those are really good. How does those have to do anything with anything? You can't trade options with those stupid little calculators. You can't look at the chart. You don't know where it's at. You can't see, oh, the chart. Oh, higher highs, lower highs. Oh, I'm in a MACD. Oh, it's going to all make an effect on where that market's going to go. So you just draw them out here on your screen. You can draw your areas of support and resistance based on where things are at. Oh, if that's my outside line, what's the chances? Oh, this is a high up here. That peak right there of our exit is above this high and it's above that high. I'd have to break two highs. I'd have to break above this high and I'd have to break above that high to get outside that line. Well, that's pretty hard for the market to do. I know that because I'm a technical analyst and I know that it's hard to break through previous highs. So it's probably going to not break out those highs. Well, maybe it could. I don't know. Well, if you think it's going to break out of those highs, then you want to buy it. If you don't think it's going to break above those highs, you want to sell it. And you want to sell short ones if you want to do it really fast, so you have a high probability. You want to do long ones if you think it's going to take a while. You make more money if you can wait longer, right? All right, but then if you do shorter, you can do it 3 or 4 or 5 times in the same amount of time. So it's all a game. Which is the right way, lad? There is no right way. There's just a different way. Just do what you like. Just find the one thing that you'll really like. You're like, oh, that resonates with me. I've done 50 of those, and I've made money on all 50, on 49 of the 50. I'm going to do that. Now I'm going to do it with real money, right? That's how you do it. So now we're going to come in here, and I'm going to show you another thing. Now we're going to go down to the next level, right? So let's come over to our slides. Come on, slides. So we're going to go to our slides, and we're going to go down to the next one. So that's straddles and strangles. Now we've done sell short straddles and short strangles, right? So we've done this one, same thing. Now this one we didn't do, but it's the same thing. You just push it out farther. So now we're going to come down to an iron butterfly. Look at this. This is important for you to understand, because if you say, well, I'm going to do this one. Well, remember when you sell, because that's what this does. If you sell these, then you can make money in that green triangle. The problem is, what if the market goes to the moon, right? And it doesn't ever come back down doesn't go up here and come back down. Now, that's where you come in here and you say, well, I'm going to do an iron butterfly because I have to have insurance. Because let's get rid of all of our drawing tools. And let's just put these back on again. Well, they're puts. They're sold options. There's a sell call and a sell put. So let's put on an iron butterfly. Let's do it. Let's all do it all together. Come over here, exit chart. Okay, so we're going to put on an iron butterfly. So all that does, we're going to sell our call. So I'll sell our call. Now that means that we have unlimited loss potential and we have limited profit potential. The amount of money we can receive is $1,705. That's a lot of money. $1,700 in the next 115 days. And so that means our break even, very simple, very easy, 1,700 right there. 1,700 right there. So that's our break even. Again, back to the normal. It's just a call off. Just got to stay in here because we're selling it. It's got to stay below there and above here. So that's our triangle for just a simple sold option. Now let's put our little triangle in there just to make it easy. From here to here. That's our profit zone because we're selling it. So it has to stay inside there. Well, the chance of that, you look at that, you're like, I don't think that's going to do that. 1,700. Well, it's got to go both directions. So we're going to come in here and we're going to now sell. We're going to sell a put because we sold a call. We're going to sell a put. So now you're going to get the other side too. So now you're going to get 1,500. So now we're going to come in here and this is going to go up here because you got to go both directions, go 1,500. So you're going to go 3,200 up here. Right? Where's our, we get a little thing up here. So we got to go 3,200 up here because it can make money. And then we're going to go 3,200 down here on the bottom side. Okay, so now our triangle isn't just the upper side, it's the lower side. The problem with this is we have unlimited loss potential, right? We have unlimited loss potential outside that window. Anything up here, we could lose all of our money. Anything up here, that's bad. So what we're going to do? Well, it's a simple process. You just come in here and buy some call options to protect yourself, a call and a put. So we come in here, we're going to buy a call up here. Now we're going to have to pay for that call. So we put it up here a little ways. Where do you want to put it? Well, you can put it up here above. You line it up with areas of support and resistance. Where do you think it's going to break above? Or how much you want to risk, how much you want to make. So you put it in here. So now you're going to have to pay $965 for the $1,712. So you're going to have to take $965 away from 17. Now, you're going to do the same thing on the other side. We're going to buy a put, and we're just going to make them equal distance. All right. And that one, you're going to pay $975. You got a little calculator over here. It tells you. So you're going to receive $1,270. So if we take those off, again, go ahead and delete them. And then put them back on. So we're going to sell a call, and we're going to sell a put. That's your short straddle. That's your short straddle. Okay. And if you did that, you'd receive $3,210. See your little calculator over here? Tells you right there. $3,210 is what you'd receive, but you have unlimited loss potential up and down. So we're going to cap that unlimited loss potential. We're going to come in here and we're going to say we're going to buy a call, and we're going to cap it. How many strikes out? We'll go 1, 2, 3. You just do it right down here. So you can drag them wherever you want, right down here. 1, 2, 3. And then we're going to do another one down here. We'll just come down here and look, I'll show you a neat little trick. 1, 2, 3. We'll just come down here and we'll just right click and we'll say, we're going to buy this put. So now we bought a put down here. So now we've capped our losses both up and down, right? So now the market can only lose up to that green line, and then anything above there won't lose anymore. So now you're kind of better off to let it go out into the longer distance, right? You added yourself a little bit of money in there. So that's how it works. So you got to go up here a little higher. So there you go. So that's how you put on an iron butterfly. All you're doing is you're selling your call, selling your put, and you're buying a call and you're buying a put, and you're doing that just for the purpose of protecting yourself in case that market goes to the moon. Now it costs you money. You have to buy the insurance. It's $970. So now you see over here, you're not going to receive your $3,000 anymore. Now you're going to only receive $1,268 to put this on. And where do you lose money? Well, it's the same. You lose money anything outside of that green arrow, the green triangle. You lose money up here. If it goes out here, you lose money. But if it stays inside there, you're going to make money. And it's going to be a various scale. I mean, it's not like you can say, well, you're going to make the full 1,200, because you're going to make the 1,268 only if it hits directly right dead center right here. That's your max profit right there, which would be 1,268. But because you're going to lose some on the upper side when you make some on the lower side, then you're not going to have a perfect 1,268. And if you make some on the upper side, you're going to lose some on the lower side, so you're not going to have a perfect 1,268. The perfect 1,268 is only if you're dead center right here. Right here's where you get 1,268. So it's going to be some variant difference scale along there. All right, there you go. Very simple, very easy. Now you have to just know that that snaky thing needs to stay inside that green triangle. And if it breaks out, the maximum amount of money you're going to lose, in this case, is the margin amount, $1,500. They're going to margin you at your max loss. And so you can see your margin right there, $1,500. So that's how much you can lose for a 1,268 profit. And now you're like, well, that's not a good risk versus reward ratio. Yeah, but you got to take, with options, you got to take into consideration where the snaky thing's going to go. That's why it's important to understand where the market's going to go. All right. Because that's your probabilities as well. It's not just the probabilities of the options. It's also the probability of the market going where you think it's going to go. How good are you at predicting where the market's going to go? Are you going to be better at predicting where the market's going to go or where it's not going to go? If you're good at predicting where the market's not going to go, then don't use the ones that make profit. Stay in neutral. Use the ones that make profit when the market runs. That's it. Now let's come in and what's the difference between what we just did here? That's an iron butterfly. Now we just go do the iron condor, which is exactly the same thing. We just put this push them out like the straddle and the strangle. It's just a straddle and a strangle with insurance policies. That's all it is. We're selling the call, selling the put, only not putting them right on top of each other. See this one here, we put it right on top of each other. And then we have our call and our put. This one here, we put a little gap between them. What's the difference? Well, it's the exact same thing as with the straddle and the strangle. The difference when you do this one, a lot of people will push them way out here, way out here. Right? So you can push them way out here, long ways away. Usually we do them equal distance. Now, what's happened? Now your triangle, right? The triangle, remember the triangle? It has a starting point way out here. Maybe if I can get a hold of it. So now your triangle goes way, the point of it, come on, way out there, right? Because this goes up to here, and this goes way down to here. And this actually, I can't draw it that far out, starts right down in here. So as long as it stays inside that triangle, as long as it stays inside of that, that below that red line, let's get rid of the triangle, make it a box, because it becomes a box at this point. Not really, but you can see that it becomes a box right there. So as long as it stays inside there, you're going to make money. Now you're not going to make as much money. You're going to make $288, not $2,000 or $3,000. Why? Because you're not taking as big a risk. You open that thing up so it's a big old box. So as long as it stays inside that box, this is why people like this model. This is why people like to trade the iron condor. It's really super popular. Why? Because it's got a big profit zone. Make that profit zone is supposed to be, that's your green. Now you're not going to make 100%, but your 100% again is going to be dead center right here. Make your max profit is going to be right here. Any different scale of that's going to be some scale of it, but basically you can make your entire amount of money all the way at expiration. You can make your full profit right there. So that's your zone. That's why people like the iron condor, because you're like, oh, well, as long as it closes out, as long as it stays inside that box, I make money. And you can make that box as big as you want or as little as you want. How good are you at predicting where the market's going to go or where the market's not going to go? Well, I think the market's going to stay inside this box. All right, well, make money on it then. If you think it's going to make the box bigger. Oh, wow, I can really make that box big. Yeah, you can push that box way out there. Make a great big box. Now you say, well, as long as it stays inside there, I'm going to make 165 bucks in 3 months, 3.5 months. Well, that's not very much, $165 in 3 months. Well, it's on a $1,000. See your margin, $1,000. You only have to put up $1,000 to make $165. That's 16% return. That's a 16% return on your money in 3 months. So let's take that. It's 4 months. It's about 4 months, a little bit better. So take your calculator. And how many? There's 4 of those, 4 quarters. Let's just say 3 quarters. Let's say we do it 3 times. So that's 16.5 times 3. That'd be a 49% annualized return. 49% annualized return if you did that 3 times on your money. Now, you can do more than one. Right? That's just one. That's what an iron condor is. Now, what is a credit spread or debit spread? I call them chicken wings. Well, Lan, I don't think the market's going to go down here, but it might go up there. Okay, well, here's something you can do. You can come in here and you say, well, I'm not going to put this side on. I'm going to come in here and I'm going to remove the upper side. I'm going to remove the call side. All right, well, let's clear the calls out. Now all you got is you've got, now you got that. This is called a credit spread. It's called a bull put credit spread. Oops, I just got rid of I should have just done this. So there's your profit zone. As long as the market stays above that red line, and here's your high probability. But as long as you can predict that the market's going to stay above that red line for that time frame, you're going to make $98 on this particular strategy. So you're going to sell and receive 335, and you're going to receive 241, or you're going to receive 331. You're going to pay 241 for your insurance policy. And you're like, well, Lan, I don't need that good of insurance. Okay, we'll push this out a little farther. Now you're only paying $171 insurance. Well, I don't need that good of insurance. Okay, well, it's going to cost you more margin. Margin goes to $2,500. The closer you have this, the better insurance you have. You make less money, but it's a higher percent gain. Notice the return on risk is 8% here. If you pull this down here, well, it's less insurance, higher margin, but now it's only a 7% return. That's because you have to have a higher margin, bigger investment. So if you push this way up here, real close, well, it's a small amount of money. It's only $51, but you only have to put up $500 and you get a 10% return. And the market just has to stay above that red line. Again, it's carnival game. Set up the carnival game to whatever you like. And now you don't have the top one on there, right? That way the market can go as high as it wants and you don't ever lose any money. There's no box at the top. The box is unlimited. It's high as it wants to go. Well, I don't think it's going to go up. I think it's going to go down. Well, then you just do the other side. You come in here, you delete all this, exit out, cancel all these, and you come in here and you're gonna sell a call up here, and you're gonna buy a call up here. It's just the opposite side. Now it's a bear call spread. So the market stays down underneath. So as long as it stays down here, anything down here, you got to keep your money. That's it. You got to keep your money anywhere down under there. I want to go up higher. What if it comes up? I'm scared. What if it comes up here and then comes back down? Well, push it out farther. See, this one here tells you well, we did this backwards. This is, what did I do? Call and a put. Oh, I don't want the put. Sorry. You got to do a call and a call. So we got to do call up here, call up here. We're going to buy a call. There we go. Okay, so now we're going to receive 120. A return on our risk is 8%, and our margin is 1,500. Oh, I'm scared it's going to go up. Oh, I'm scared up there. Okay, we'll push it up higher. Now you're going to make $28. That's not worth doing. Bring it down a little closer. Now I make $51. Now I'm going to make $80. Okay, that's better. So I make $80 in 3 months, which is 4% annualized, 4% return. That's still, you know, I mean, 4 times 4, that's still 16% annualized return. And you're way up here. You got to drag your box up. Anything below that red line, you got to keep your money. Now, this is such a popular strategy that this is a strategy that a lot of traders do this one. A lot of big hedge funds do this one because it's, the probabilities are so high in your favor. I'm going to show you something really cool. Now, we're going to talk about a protected wheel strategy tomorrow. This is basically the wheel strategy right here, what you're looking at. It's a protected wheel strategy. You can do it like this. We do it with put options. So we'll talk about that tomorrow. Tomorrow morning, 9 o'clock, we'll take this to the next level. We'll start doing some strategies with it. But I want to show you over here on the, if you go over to, remember we were looking earlier at the S&P, which is the indexes. So if we go over to the SPY and we come down here and you're like, well, how far down do you think that S&P is going to go? Well, I don't know how far down it's going to go, but this is our Fibonacci scale. And we know that we're kind of we did our analysis on it before, so I'm not going to do it again. We're just going to come in here. I'm going to show you something. We're going to come in here and we're going to put one of these chicken wings on, one of these bear put spreads, bull put spreads. So we're going to come in here and we're going to actually sell our put way down here. And we're going to buy a put way down here. We're going to go long ways away. I mean, a long ways away. Watch how far away we can go with these options. This is what's really cool about the S&P. All right. Do you think the market's going to go way down there? How far down do you want to go? If you come and look at the options, and remember, volume is your friend. We're going to go look at 115 days out. You don't have to go 115 days out. You can go 30 days out, but we're doing 115 for right now. So we're going to come in here and look at these out of the money that we're doing puts. So let's just look at the puts. So we're come way down here. Look at where they're at. Look how far out they are. Look at the odds. The odds of making money. 89% chance that the market's not going to go down there. You can go to 90. We can go down to 90%. In fact, let's put this one at 92, and we'll put this one all the way down here at 90. Look at that. And look at the volume on this thing. The spread is only $5. There's people down here doing, look at that, 3,766 of them, 11 of them today. We probably want to put this here a little bit more, but the volume's not that great all the way out there. But you know, this is the S&P for 100 days away. But you can see the volume out there. It's there. Spread's only $4. You could probably get that filled. I wouldn't doubt it. I bet you could get that filled. You can make $594. So that's a $62. That's 90% chance. What's the chance of the market? Do you think the market's going to come that far? I mean, what catastrophic event would have to occur and you're still making money? That you still make $62. That'd be 6.2% annualized return. In not annualized, that's 6.2 in our time frame, in our 3 months, 4 months. So we're going to go 6.2 times 4. Say we can do it every quarter. That's 24% annualized return. Look how far away you are. And you make a 24% annualized return if you put your money just on that. Your profit box is right here. From here, anything inside that box, you're going to make your money. Anything inside that box, you're going to make $62, which would be 24% annualized return. Anything inside that box. If I were you, now I'm not telling you what to do. I can just tell you what I'm going to do. I'd do these. I do these all day long. In fact, I do. I do a lot of these. This is my favorite one. That's why I renamed them chicken wings. Well, why are you chicken wings? Well, because it's one wing of an iron butterfly, or of an iron condor. It's the chicken side. I think the market might go up here. And if I had a chicken wing up there, I'd lose money. But if I only have one side of it, I don't think it's coming way down here. Right? I don't think it's coming way down there. So I can be pretty confident putting it on there. In fact, I can look at this little Fibonacci ruler thing, and I can say, I don't think it's coming down to 61.8. All right, we'll push it up there. I don't think it's going to be down here. So now I can do that. I can make $100, which is 10% annualized return 4 times. That's 40% annualized return if I'm just willing to take it a little bit higher risk. So the probability of making money, 86% chance of being out of the money. Well, I'm willing to go to 80% chance. Okay, well, that's more common. 80% chance. So you go to an 80% chance of making money, and you put your insurance policy right here. So you get $1,200, and you pay $1,000 in insurance. You're going to make $212, and the market just has to stay above that red line. And you can make $212, which is 14%. 14 times 4. 14 times 4. If you could do that every quarter, that'd be 56% annualized return. And anything above that red line, you get your money. And you got an 80% chance. It says right there, probability of being out of the money, 80%. 80% chance that market's not going to come down there. And then you could look at it yourself and say, well, do I really think the market is going to come flushing down? You know, do I think it's going to come down there? If you do, you can push it farther. Or you can wait till it starts to go up. Of course, if you wait till it starts to go up, then the premiums go way down, right? The reason the premiums are as high as they are now is because the market's coming down. We talked about that too. All right, guys. That's a fun one. And we can then take this little strategy right here and turn this into the wheel strategy. And then if you get filled on this, you just take the shares. So what? And then you got a protective put to the bottom side. You take the shares. Then if you don't mind the shares, you can push this up even higher. See? Now that's your profit zone. Anything above there, we're going to take that off the screen. So anything above there, and you're going to make $300. That's 20%. 20, 40, 60. That'd be 80% annualized return if you never got filled. And then if your shares get filled, well, now you own the shares. Oh, so what? You got a little built-in stop order right there on your shares. And you're not going to lose anything if it toughs all the way down here. Who cares? You just wait for it, turn around, come back up, sell covered calls against it the whole time. All right, guys, we wore ourselves out. Let's go. We'll build on this tomorrow morning, 9 o'clock. We're going to do it all 3 days. We're going to do Tuesday, Wednesday, Thursday morning at 9 o'clock, and we'll knock these things out. We got 2 more days of doing these options. We'll go do some more study tomorrow and put these on, and then on Friday we'll go apply them to a bunch of current markets and see what we do in current markets. But that's kind of your game. Now all you need to do is just get your software and go do this. Go put a bunch of them on and do them in the demo account, of course, so that you can practice and see what they do. But that's what they're going to do. You can draw it on the screen, and you can see right there. If I did that and this is what the market did, and you can sit and wait and see what the market does. But you can, that's your back test right there. $300, $1,500 investment, margin requirement, 1,500 is all you have to put on that 20% annualized return, or 20% return. It'd be a 20, 40, 60, 80% annualized return for that strategy right there. And then if you got the shares, you get the shares. If it comes down here, you get the shares. You buy the shares. Who cares? You got a bunch of money. You got a bunch of shares in the stock market. Of course, it's a lot that you'd have to have $61,000. $61,000 to take your shares. You don't have to take your shares. You're protected. You can just liquidate, take your loss. What would be your loss? Well, your max loss would be $1,500. That would be if it closed underneath that green line down in here. Actually, down in here, max loss would be underneath the green line. Hit the purple line underneath the green line. Then you'd have max loss. That's it. You're going to have max loss. Underneath the red line, you're going to have max loss. It's just got to stay above the red line. This is going to make money as it comes down, but it's not going to make money between the red line and the green line, so you'd lose that money. So just anything below the red line, you're going to lose $1,500. But you don't have to take the shares. You could take the shares if you wanted to, but then you have to come up with, in this market, you have to come up with $60,000. So to not come up with $60,000, you just bite the bullet and take the $1,500 loss. All right, that's how it works. That's why you push it way down here where the odds are much higher in your favor that you don't have to do that. And then, just not make as much money. But it's up to you. How well are you at predicting where the market's going to go versus where it's not going to go? That's all it is. That's the name of the game. All right, guys. If you have any questions, let me know. Pretty simple stuff. You're just pushing these little lines around on the screen. Just pushing the little lines around on the screen, deciding where you think the market's going to go, where it's not going to go. Exit chart. We're going to exit all. Exit these out. And we will see you tomorrow morning at 9 o'clock. If you have any questions, let me know.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.